Hey, welcome everyone to another Tuesday edition of our market update webinar. Hope everyone is safe and sheltering in place. Seems like these weeks are getting a little bit longer, but hopefully your families are safe and sound. To give you an idea, this is a Q&A today, so if you do have questions, Brian and I are here to answer those. So again, use the chat feature. Andy's online as well. She will gather all those questions, and then we can spit them out here. Planning on doing, again, a half hour, 45 minutes at the most. I know you're all busy getting back to work or your families, but we feel it's very important to always have constant communication with you. And in light of the markets again this week, I think it's timely that we're doing this once again. For those of you that don't recognize my voice, I'm Joe Anderson, president here at Pure Financial Advisors. Brian Perry, of course, is with me. He's our executive VP and director of research. So what we're doing with all of these different webinars, we're sending them back out to you, our clients. If you want more information, you can always go to our website and click on our COVID-19 responses. So our webinars, white papers, blogs, and things like that. As things develop, we're trying to gather as much information as we possibly can and get you that either at your own convenience or joining us live here on Tuesdays. So what the agenda is today is that a lot of you have asked of us, your advisors, different types of questions. And so we've gathered the most common questions that we've been getting, and we'll want to make sure that we answer those just to give us some framework. But if you do have additional questions, just type those into the chat box. And like I said, Andy will gather those, and we'll just have an open discussion on Q&A. There's also different opportunities, of course, in regards to your financial planning, a lot of I guess, unique strategies when it comes to taxes in your retirement plan. So I can dispel some of the myths that are out there, some information that's hitting the airwaves, and looking at what we're doing for all of you, our clients, in regards to times like this. So I guess to open it up, we'll just kind of see, we'll just start with the questions that we have jotted down, and we'll go from there. So first question. I'm worried about the economy and how bad a recession might be. Should I get out of the stock market now?
Yeah, that's a pretty common question these days, and maybe more so again the last couple of days after we had a good rally followed by a little bit of a sell-off here the last few days. I'm not sure how bad the recession is going to be. I think it's pretty clear we are in a recession. It's a fairly unprecedented drop in the economic climate. It really depends on how quickly we pick up coming out of this. You saw this week Georgia announced plans to get back to some sort of normality as soon as maybe this Friday. I think, in a lot of other places getting a little bit closer to return to some sort of new normal. But we'll just have to wait and see. But I think the bigger question is, should you get out of the stock market? And the answer is probably no. I mean, obviously, I don't know everybody's particular situation, but it really depends on what they're trying to accomplish. And I would hope that, at some point, looking at what kind of mix you have, there's probably some stocks in there. There's, for a lot of folks, some bonds in there and everything else, and a mix of those safe assets and conservative assets. And so as long as your allocation is set in order to meet your goals based on your cash flows, there's no need to get out of the stock market. That's why you have safe assets in there to counterbalance the stocks that you do have.
This is trying though, right? I think we've always preached, buy low, sell high. And so, of course, we're rebalancing the accounts, and, just by that discipline nature is that we're selling things as they go out of the band. So selling high and then buying low. But in practice or in theory, you can talk about it, but when the emotions take over, it's a little bit more difficult to do. That's why having a very disciplined approach to our overall investment strategy, I think, is key. So, next question. If I have a lump sum of money, is this a good time to invest?
And that kind of dovetails with what you were just saying, Joe, is that the math would say probably. I mean, if you just look at over time, the stock market tends to go higher. And so all else being equal, if you put money to work, your odds are pretty good you're going to make money. But emotions come into it, of course, right? And how comfortable are you right now putting a lump sum? And so sometimes it comes back to how big of a percentage of your overall net worth is that lump sum, and does it make sense to put it all to work right away? Or if the market turns around and falls after you do, is there going to be too much buyer's remorse, and should you instead maybe dollar cost average in or something?
Yeah, I think that's Murphy's Law always comes into play here. Is like, oh, I've been waiting for the market to go down to make my lump sum investment. And then as soon as you do, of course, the market's going to drop another 2,000 points. So, I think it's looking at, should it be invested? Our philosophy is that if it's for long-term goals, such as your retirement, and it's not your retirement date, it's your life expectancy. So a lot of you on the call, right, it's 20, 30 years of life expectancy. So you want to make sure that it's invested appropriately. But if it's easier to dollar cost average in, make sure that you have a process, right? So talk to your advisor and say, I would like to put in, $1,000 a month for the next X amount of months, and make sure that you follow that process no matter what happens to the overall markets, because then, we might overthink things and then think that we can potentially time the markets, which is very difficult to do. So next question. With bond yields so low, why does it still make sense to own bonds?
Yeah, great question. And, I think that it does still make sense to own bonds. It's what kind of bonds do you own is really the key question, right? The reason you still own bonds is because they've gone up despite all the mayhem around us over the last few months. They had, the bond market had a little bit of a bumpy patch in the worst of the coronavirus until the Federal Reserve and the government came in and provided some support. But for the most part, they're up 2, 3, 4% on the year and up 1% this quarter. And that's why you own bonds, because they don't act like stocks. And in an environment like this, you want to have something in your portfolio that isn't falling in value if stocks are falling. But what kind of bonds do you own, right? And there's a wide variety of risk you can take. And here, what we've chosen to do is own not a lot of corporate bonds in order to minimize the risk if the economy slows down and companies are in trouble. And we recently, just in the last month, reduced the interest rate exposure of the bonds that we do own just because of the fact that interest rates are so low.
With you probably get this too, isn't a bond, if interest rates go down, if they continue to go, or if interest rates go down, bond prices go up, right? So can you talk a little bit about that dynamic? Because I still think or as interest rates revert back and go up, bond prices are going to go down. And then if interest rates do go up, I don't know how much lower that they can go down. Isn't that a guaranteed loss?
Yeah, really good question. First of all, bond yields and bond prices move inversely, right? So when interest rates go up, bond prices fall, and that makes sense. If you're going to lend somebody money for 10 years at a fixed rate, and now your neighbor could get a higher rate, your bond's not worth as much. You're locked into that contract. And because of that, bonds have interest rate sensitivity, and the more interest rates go up, the more they fall in value, and the more interest rates go down, then the more that they increase in value. And they've had a nice tailwind as interest rates have come down over the last better part of a decade, but certainly even just in the last 18 months. And you're right. If you own, let's say, a 20-year bond with a duration, which is a measure of that interest rate sensitivity of maybe 15, and interest rates were to go back up, you could lose a lot of money. And that's why the bonds that we own, because we do think that there is a little bit more risk for interest rates to go higher than to go lower. That's why we made the move to shorten the average maturity of the bonds in order to protect against that. We still want that diversification that bonds provide. We still want the income that they provide, but we also want to cushion against the fact that, interest rates, maybe they can go lower, but there's probably a floor, and we want to protect against the fact that at some point they can go higher.
The income that is generated through the bond is not a lot, but at this point we're using it as I guess maybe a safety net, or a lack of a better term.
Yeah, I think depending on the environment, bonds usually provide a couple different functions: diversification, safety, cash flow. I think in varying percentages depending on what you're trying to accomplish. Right now, the cash flow isn't what it used to be, but you're still getting the diversification and the safety, along with a little bit of income. And keep in mind, too, that all else being equal, when interest rates are low the way that they are, inflation tends to be low. And so what you're really focused on is just hopefully keeping pace with the rate of inflation, maybe exceeding it. And right now, although interest rates on your bonds are very low, inflation's very low as well. You can flash back to the 1980s, 1970s. You had much higher bond returns, but you also had higher inflation. And so you're really looking for that differential.
Andy, next one. All right. I own international stocks in the portfolio you manage for me. Aren't those risky, especially right now? And when are they going to do as well as U.S. stocks?
Yeah. So, anything can be risky, right? And so I think it's important to keep in mind what you own. And so, yes, there's for a lot of clients a percentage of emerging markets in there, but it's a pretty small percentage. It's kind of like adding a little bit of pepper to your food. Most of the stocks in there, it's the Nestle's, the British Petroleums, the Toyotas of the world, companies that are just as well known in the US as, I don't know, GE or Ford or something like that. So these are high quality companies located in countries like Japan and France and Germany. The reason that we own them is A, because there's a lot of great companies around the world, and B, because they provide diversification. Unfortunately, diversification works in both ways, right? You can't get diversification doesn't mean that when the S&P 500 is going up, everything you own goes up, but that stuff also goes up when the S&P falls. It works in both directions. And so over the last several years, international stocks haven't done as well as US stocks. If you look prior, back in like the decade of the 2000s, international stocks did quite a bit better. And so again, this is a diversification play. Looking more specifically to the current environment, it does appear that one of the things that has hurt international stocks in the last few years is that the US dollar has been really strong. And when the dollar is strong, that's bad for US buyers of international stocks. With some of the decline in US interest rates, as well as the weakening US economy, it could be that we're getting poised for a time when the dollar declines. I don't have a crystal ball on that, but the dollar does tend to move in cycles. And if it begins to head lower, that would be a positive for international stocks.
All right. It seems like my small value stocks have underperformed large growth companies. Are you going to make any switches there in regards to switching out of small companies?
Yeah. So I think 2 points on that. One is that you already own, and we in our portfolios already own large growth stocks. In fact, the biggest percentage of the portfolio is large growth stocks. You know, I don't know that everybody realizes that, but if you broke our portfolio, the portfolio that all of you out there own, into large companies and small companies in value and growth, the largest weighting is to large growth companies. So it's not that you don't own them. It's just that relative to the S&P 500, you also own a lot of other things, because we define the market not as large U.S. growth companies, but as all U.S. companies, international companies, bonds, et cetera. So about 40% of a lot of the portfolios is actually in large growth companies. The reason we have the small and value companies in there as well is because over time they've provided higher returns. We don't think it necessarily makes sense, and we've been evaluating this. And in fact, I was just on a call earlier today evaluating this. Small value in particular has underperformed quite badly in the last 6 months or so. We don't think it makes sense, if there's a position that we believe in and that the research supports and logic supports, to suffer through the downside or participate in the downside, but then not stick around for the upside. We don't know exactly when the cycle will turn, but every bit of evidence as well as logic suggests that it will. And so since we kind of participated in the downslope, we want to participate in the upside as well.
I think we bought the risk, right? Because smaller companies by nature, they're more risky because a lot of them tend to fail. But the ones that do succeed, they succeed by a large margin. And so you're going to see a lot more volatility in smaller companies than you would in big established companies. You know, just if you think of it that way, you know, you got your big, strong companies, they're not going to be as volatile, even though all stocks are absolutely risky. Smaller companies tend to have more risk, but within that, you will receive a higher expected rate of return. And so you have to look at the lens a little bit wider, you know, in regards to the diversification. So next question. Why don't I just own Apple and Amazon?
And Microsoft and Facebook and Google.
Netflix.
Yeah. Well, Netflix is a pretty good stock to own right now because we're all using it a little bit more, kind of like Zoom. You know, I think that this is similar to the previous question in the sense that, believe it or not, Apple and Amazon, along with Microsoft, are the three biggest holdings in our portfolios. So that's it right there. They're the three biggest companies in the U.S. stock market and, in fact, in the world. And they're the three biggest stocks that we hold in our portfolios. Relatively speaking, compared to the broader universe, we own a little bit less. So we own, I don't know, 0.75% of each of them. And again, that's just getting back to diversification. If you look at the S&P 500 right now, Apple, Amazon, and Microsoft by themselves are 15% of that index. Great companies. We're big believers, which is why they're the biggest holdings. We just think 15% of any, you know, of three stocks is just too much of a concentration. It's great when they're doing well. It's less good when they're underperforming. And so a little bit more diversification.
You know, I think a few things too is to consider. Like right now, there's going to be a lot of news, right, in regards to pharmaceutical companies, biotech firms, things like that are working on a vaccine. So does it make sense to weight the portfolio maybe to those sectors? Because hypothetically, you know, if XYZ company comes out with a vaccine, you know, that stock price will probably, you know, increase substantially.
Yeah, definitely. And I wish I knew which one was going to come up with it because we would just put everything in there. About 12% of the portfolio is in pharmaceutical companies in the healthcare sector. So definitely a pretty large representation there. As far as going out and trying to pick the winner, I'm not sure that anybody knows which company is going to successfully develop a vaccine. And then frankly, too, they may or may not profit from from it. In this climate, it's entirely possible that the vaccine is subsidized or free or something like that. And then the flip side of it is, what about all the companies, because there's thousands of companies or hundreds at least in that industry. What about the hundreds of companies that don't produce the vaccine? What does that mean for their stock prices, right? And so it's a little bit tough to pick the one company that's going to shine through there, which is why, again, we hold a broad representation in that sector.
Next question. All right. Saw in the news, oil plummeted and we're even negative. What's going on here?
Yeah. Well, there's two things. One is fundamental and one is a little bit more technical. The fundamental is just that the economy is weak and there's more supply of oil than there's demand. It's just the basics, right? We have essentially very little to no air traffic right now and a lot less driving. And so there's not as much oil needed. Then you had OPEC and Russia squabbling and actually increasing the supply of oil about a month and a half ago. They've since reversed that, but those cuts haven't taken effect. So you have a lot of oil out there. What happens when you have oil that you're not using is you need to put it somewhere. You need to store it, and it goes into storage tanks. Those storage tanks are full or just about full. And think about it. If you have a storage tank that's full, you don't have a lot more space, and somebody wants to put more oil in your tank, you're going to charge them a premium price to do that. That gets into the technical part of it. And what you've seen is oil prices on futures contracts, and this gets a little bit technical, but for months that in the next month or two have actually gone negative because the cost to store the oil, if you took delivery of it, is pretty high. If you look further out to, I don't know, contracts that are expiring next year, that gives maybe a fairer representation of the price of oil, which is that it's down around $20 a barrel, which is quite low. It's off quite a bit this year, but not negative. I think that the negative is more of a technical thing than anything else. But it certainly is attention grabbing. And the decline in energy prices is obviously a sign that people are afraid that the economy is weak right now and could continue to be weak, and just waiting to see when transportation will pick back up.
All right. I think biotech and pharmaceutical companies are going to do well, especially if they find a vaccine. Why don't I sell my mutual funds and buy individual stocks? So we just kind of covered that.
Yeah.
Next question. All right. What are your thoughts on how the bond market will perform over the next 12 months with the trillions of new debt?
Yeah, that's a great question. Interest rates are pretty low. The common concern is that, hey, there's trillions of dollars of new debt, and this thought kind of continues. The budget deficit's out of control. How are we going to finance it? Interest rates are going to skyrocket. Inflation's going to skyrocket. And, all that may or may not come to pass, but the odds of it coming to pass in the next 12 months, I think, are pretty minimal. I think in the next 12 months, the bigger worry would be some sort of deflation or disinflation and a weak economy as opposed to inflation. So over the next 12 months, my guess is that interest rates stay low, which is why we made the move to shorten up the exposure that we have in our portfolios, because there's not a lot of potential, I think, for interest rates to continue to decline, but there's probably also not a ton of impetus for them to go higher as long as the economy remains as weak as it is and the Federal Reserve is out there buying bonds. So my guess is interest rates remain low for the foreseeable future. Usually people that are concerned about the new debt are focused maybe a little bit further out, and further out, you get into how do you pay for all this new debt, right? And historically, there's a couple different ways. You can default on it. I don't think the U.S. is going to default on their debt. You can grow out of it if the economy does well enough. That's what I hope comes to pass, but who knows? You can inflate your way out with higher inflation. Or, Joe, the most common one, right, is what do?
You probably tax it.
Exactly.
So, yeah, there all sorts of different things I guess will play out. We just don't know what, when, and how severe. I think if we look at the stimulus that they're pumping in now is needed just to get us through these really trying times. But then also making sure that you're defensive in regards to the overall strategies that you're putting together to make sure that you can accomplish your goals. So I think, when you look at your overall planning needs, it's all right, well, how much cash is needed from the overall portfolio over the next several years? And then from there, then you can calculate, well, how much money do I have in safe assets? Do I have to sell stocks, to provide myself income? And if the answer is no, which is probably in most of all of your cases, then you can kind of weather out the storm here for the next several years. I don't know how painful it is. This is really painful now. I mean, this is a new territory. People are getting anxious. People are getting anxiety. People want to get back to work. Some people don't. I mean, so who knows what the next month is going to play out. But over the long term, I believe, we will get through this. And if you can take advantage of certain volatility within the market, such as tax loss harvesting, Roth conversions, and so on, I think it's controlling what you can control, in doing the best that you can from that perspective.
Yeah, I agree 100%. We'll come out the other side of this. It's just, the people that take advantage of the opportunities and stay on track for their long-term goals are going to be really happy they did. And, the people that don't are going to probably have some buyer's regret. And then it's just positioning yourself for, are there any changes to your situation going forward, right? I mean, a lot of our clients we're really focused on taxes with them, right? So if taxes are going to go higher, well, then you're in a golden spot because you've already likely been doing tax positioning and tax planning.
Andy, any questions?
We do. We have a few questions. I want to remind people, click the Q&A button at the bottom of the screen in order to send in your questions as opposed to the chat. We had a couple of them on the negative oil prices. How will the recent changes in the oil industry affect us long-term and short-term? And what are the best and worst case scenarios for those negative oil prices?
To be facetious, I suppose the best case would be that you go to the pump to fill up your car and somebody pays you to do it, but that's not going to happen. I think that the benefit of lower oil prices trickles through the economy, particularly come this summer when hopefully we're all back at work and traveling and going on, Memorial Day trips or 4th of July trips, is lower prices at the pump are the same as a tax cut. They put more dollars in consumers' pockets, which hopefully they can spend elsewhere. So I think that's the most likely direct outcome. As far as the impact, with some different companies and stuff, obviously there are winners and losers. Some of the big major oil producers like the Exxons and Chevrons of the world can likely weather this pretty well. When you look at some of the higher cost producers, the shale oil producers in the Bakken shale and stuff like that, they could run into difficulty. Where you're seeing the most direct impact of that is outside, again, of some futures traders in oil, is in the high yield market. A big percentage of the high yield bond market is energy companies. And a lot of those companies are, potentially with oil prices where they are going to have difficulty remaining solvent. And so you'll probably see some trickle down effects through there.
Okay, the next question, we've got a couple that are very similar to this, so I'll just ask the one. How is Pure repositioning our portfolios, the suite of companies that will come out of this crisis with the best growth potential, and likewise minimizing those companies that are poised to suffer in the brave new world?
Yeah, so I think there's a couple things. First of all, I'm not sure that we know exactly which companies are going to do the best and the worst kind of thing. I mean, for instance, right now, Zoom is in the news, right? For a lot of reasons, they're very popular now, and it's a great user interface. So that stock has done well, and there's a small sliver of it in the portfolio. But will that continue to be the leading video technology provider in the next 5 or 10 years? I don't know the answer to that, because there are other companies looking to compete in that space and maybe come up with a better product. The way that we do it is twofold. One is that we try to own a lot of different companies so that we own all those that do well, in the absence of a direct knowledge of what's going to do best. The other is, again, some of the changes we've made in the portfolio is that in looking at stock prices being beaten down, we've increased the rebalancing bands in order to give stock prices room to run on the upside to participate in more of that. We like the idea that international stocks and emerging market stocks could do well if the dollar begins to weaken, which we think is a possibility. And then we're looking in the portfolios as well at the profitability metric that we have in portfolios, which is we talk a lot about small in value, but we also screen the companies that we own for profitability, which is that all else being equal, a more profitable company measured on the past year's earnings is likely to be more successful than a company that's less profitable. And that's something that we don't always talk about as much, but is an important component of the portfolio in all times. And I think especially right now, where for a lot of companies, it's not so much how their business model is going to do, it's whether or not they can stay solvent for the next year until things normalize. And in that case, a more profitable company is going to do better. So we're pretty positive about that and the tilt that we have in portfolios in that direction.
So, I mean, the screening process is key. We're making sure that we're smart about the companies that are held within the overall portfolio. The companies that we partner with are screening these on a daily basis.
Yeah. And so like another example is that if you think of like the really small companies with a lot of debt on their balance sheet, those are the companies that are going to struggle the most in this environment. One of the reasons we use some of the funds that we do is because they screen out those companies. So they specifically exclude the most debt-ridden small companies, which are the ones most likely to go bankrupt in this environment.
Next question.
What's the deal with the guy on the radio that says you can invest with him and take advantage of the increase in the stock market, but won't lose a dime with the next market downturn? Is he goofy?
Is he goofy? Yes. What you probably hear quite a bit of these pitches is what that is. It's an equity indexed annuity or fixed indexed annuity. And what the insurance, I guess I can tell you how it works, but how it's sold is you could take the upside of the overall market with zero downside risk. And it sounds really good. Is like, well, who doesn't want stock market like returns with zero risk? The fact of the matter is, it's just not. It's fantasy land. If you're taking risks in the market, you have to anticipate the full risk of the market. What the insurance company is basically doing, they're buying zero coupon bonds and then buying call options on whatever market. So let's say that they're stating, you can get S&P 500 type returns. So they're buying a zero coupon bond, and then they're buying call options on top of that bond. So if the market does go up, right, then they exercise the overall option. If it goes down, same, they got puts and calls on both sides of that zero coupon bond. So it's fairly technical, but there's no way that you will ever receive market-like returns. You will get like fixed returns. What we're seeing anywhere from 2 to 3% potentially. It's a fixed annuity is what you're buying, but it has bells and whistles on it to try to increase the overall return or to have a better story in regards to the sales force that sells these. When it looks at the commissions and how long that you have to keep your money within these products, your internal rate of return is going to be very, very low. It's almost going to be somewhat, in pace of inflation. But you have to tie your money up within that overall contract. So if you guys are getting pitched at or more curious about how they actually work, if you want to send me a contract or if you want to send me a proposal, we can break that down and show you exactly how it works, just so you have a better understanding. There's also products out there, too, that you'll hear is that you'll get a guaranteed income for life from these. Those are not investments. Those are risk transfer products. So if they're touting them as an investment, I mean, it's not prudent. You're transferring risk to an insurance company for let's say a certain income stream. So if you want a guaranteed income of X, yes, you can buy an insurance contract that would give you that guaranteed income. But you just want to look at what the internal rate of return is within the overall product, because how they're maybe pitching them and how they actually work are two different things. So we're very familiar with all of these products out there when it comes to getting income, because when, like back in 08, 09, the credit crisis, throughout that time period, you would hear a lot of pitches in regards to income, like master limited partnerships. You would hear, of course, with fixed index annuities, you would hear, different things that these companies would package, and it sound pretty good. But you have to read the fine print. And I'd be more than happy to screen anything that you guys have or come across to make sure that you truly understand, what you're getting into. Because at some point, at the end of the day, you have to sleep at night, right? And if there's, there's this GMO point, which Larry Swedrow would talk about. It's like you make it to a certain point, you're like, get me out, right? I can't do this anymore, right? And so from there, if you do want to transfer risk and say, I want to guarantee, all right, well, you could do that. But these insurance companies can change the rules throughout. So the guarantee is only as good as what is written on the paper. So, if you ever come to a point where you're like, I don't want stocks, I don't want bonds, you want CDs, or if you want to look at these insurance contracts, would be more than happy to look at it. We don't sell insurance. We're not licensed insurance agents, but we absolutely know how the products work. And if it's something that you absolutely want to take a look at, we can at least show you the pros and cons and give you a better objective to see if it makes sense.
There was a couple
so
of
he
questions.
could be a little goofy, or she could be.
There was a couple of questions that came through while we were going through the common questions that I think might have caused some confusion. So I'm going to ask these two together. Does Pure own individual stocks? I thought the portfolio consists of various mutual funds in different categories. And then also you say the portfolio we all have. I thought we all had portfolios based on percentages of risk, stocks versus bonds versus cash, 60-40 or 40-60 as examples.
Yeah, let me answer those, and I'll throw it over to Brian. Is that, yes, we own individual stocks that are packaged in exchange-traded funds or mutual funds. So just to, a mutual fund is a basket of either individual stocks or bonds. So yes, you do own individual stocks in the package of a mutual fund or an exchange-traded fund or an index fund. You just have maybe a fractional ownership or whatever it is. Do we pick stocks outside of those parameters? The answer is no. Some of you have individual stocks. Let's say if you have a privately held company, that you can't sell, or that we're doing some hedging strategy within those individual stocks because a large portion of your overall net worth might be in your overall company stock. Yes, we build that portfolio around those particular holdings. All of your portfolios look completely different in regards to your risk parameter, how much, what tax bracket that you're in, how much income that you need. But our investment philosophy is the same around the firm. So when we look at constructing the overall portfolio, we have a certain basis that we go by, but each of your portfolios look a little, they're going to look differently depending on what your specific goals are.
Yeah, I agree 100% with all of that. I was giving figures rolled up through the mutual funds, and I was taking just a representative portfolio. So I didn't read the disclaimer that, I was giving generalities and everybody's going to be a little bit different.
Yeah, but it gets confusing, and so no, we really appreciate that that question.
Any thought about gold?
I don't think about gold often, and here's why is a couple of reasons. One is that the long run return of gold is really not good. It's hardly kept pace with inflation, if it even has. The other issue is, and we've looked at this with investment management, with portfolio construction, is deciding how to own gold in a portfolio, even if you wanted to own gold, I think is challenging. And what I mean by that is, if you buy gold, it's because you're worried about very high inflation or deflation or the collapse of the dollar or something else bad. And in any of those scenarios, in order to have the gold actually help you, you need a fairly large holding in it. So having 5% of your portfolio in gold is not going to help you if, the zombie apocalypse comes or something like that. But the flip side is that if you own half your portfolio in gold, the rest of the time when the world's not coming to an end, it tends to be an anchor on the portfolio and not perform as well as more cash flow generating assets. So we're not sure how to size it in a portfolio where it would make sense. Also, every investment that we own either generates cash flow or will generate cash flow in the future. So companies, bonds, et cetera, the way that you value them, an investment, is by discounting future cash flows to net present value, and gold doesn't generate cash flows. So now it comes down to an exercise in what you think somebody else will pay in the future, which can be a valid exercise for some people, but it's fundamentally different than discounting cash flows, which is what we look at and what the funds that we invest in look at.
Yeah, and I think you got to be careful too on how, for those of you that want to purchase gold or silver or some precious metals, we do have some of that in the overall portfolio, natural resources and so on. So we are diversified from that range, but I think when things get a little bit dicey or scary in the overall markets, people might want to flee to a hard asset such as gold. But be careful, because there's a lot of shysters out there as well on how you want to purchase that and how you want to store it. And do you want to buy an exchange traded fund such as ticker symbol like GLD versus physically owning the gold and then storing it somewhere? Or are you buying coins? So that there's multiple ways to get that diversification. You just want to look at, all right, well, what's the cost to you? What's the spread? Because there's, if someone's selling gold, they're making money off that. So what is that actually costing you? So multiple ways to do it. If you're wanting to purchase gold, probably the exchange traded fund might be the most best, because the liquidity factor in there, but it's all personal preference there.
Okay, we've got another question. This one might need a little bit more information. All it says is mortgage rates, government backstop mortgage-backed securities, ?
So if I'm going to extrapolate from that, because it's asking about mortgage-backed securities, it sounds like, and treasury rates and mortgage rates. I'll comment a little bit on that. I'm not sure exactly what the question is, but if you look at what mortgage rates have done lately, they haven't fallen as much as, let's say, Treasury rates or some of what the Federal Reserve has done. And the reason being is because although mortgage rates tend to have a correlation with Treasury rates, they're more closely linked to mortgage-backed securities. And a mortgage-backed security is basically when you take out a mortgage on your home, the bank doesn't keep it. They package it together with a bunch of other mortgages, turn it into a security and sell it in the marketplace, and then it trades. And what happens is that there's additional compensation buyers need for buying that mortgage-backed security instead of a treasury. And most of the time that additional compensation isn't that great. But with some of the uncertainty in the last couple months and worries about whether or not people are going to be paying back their mortgages, because right now they have essentially permission in a lot of cases not to, that additional compensation you need to buy a mortgage-backed security has increased a lot. What that means is the trickle-through effect is that mortgage rates haven't gone down as much as you might otherwise expect. And in fact, in some cases, it's getting a little bit challenging because some mortgage providers are worried about their current business with getting paid back from homeowners and stuff like that as well.
So if I own a mortgage, the bank doesn't necessarily hold on to that paper.
Almost never.
They package it. So, I remember back in 08, 09, I mean, it seemed like every 15 minutes that these mortgages were getting sold, and all of a sudden, hey, now this XYZ company owns your mortgage, or, ABC now owns it. And so the banks are getting rid of that risk by packaging, securitizing all those mortgages. And then so us investors now can participate and say, hey, what's safer than a mortgage, right? Yep. People always paid their mortgage, and then that's what got us into trouble in 2008. So, we want to look at mortgage-backed securities. Do we hold those in our overall portfolio? What's the risk parameter of that? In our philosophy in regards to fixed income, we want to stay a little bit safer on that yield curve.
Yeah, and I just want to be really clear that although there's been a little bit more volatility in that market lately, it's not like 2008 in the sense that the mortgages in question are for creditworthy borrowers, and they're backed by Fannie Mae and Freddie Mac, which have the backing of the U.S. government in turn, which is a very different scenario from 2008, which was mortgages issued to people that maybe didn't have a job or any assets, didn't have any kind of government backing, and there was just the level of risk was many, many multiples beyond what's going on now. So it's not. I wouldn't worry about a mortgage explosion the way that we saw in 2008 taking down the financial system.
So I guess the big difference there is people were getting large mortgages by lying on applications, if you will, like liar loans, they call them, right? So you didn't have to show any proof of what your income is. And, now all of a sudden I have this large mortgage that I couldn't necessarily afford anyway.
Yeah, and that hasn't been happening in the last 10 years. So this is just, hey.
Now people, instead of me not being able ever to afford the mortgage, now I might be out of work or furloughed, or that I have a little bit of a financial setback for maybe 1, 2, 3 months. Hopefully, there's always going to be a portion of that overall population that loses their job, and it's going to take them a little bit longer to find employment. But it's a totally different scenario.
Yeah, it's a question of when they can pay the mortgage, not if.
Next one is, have you or when will you be repositioning for the negative issue in the bond markets?
For the negative, so I take that as the negative interest rates. Yeah, we have, and that's one of the reasons that about a month ago we moved some of our longer term bond holdings. And again, we were never very long in maturity in the bond market. We tended to be intermediate, but we took some of those and moved it into very short term bonds because of the negative interest rates, and in order to protect against that, just because. There are countries around the world where interest rates have gone negative, but they haven't gone, negative 3% or anything. It's been negative just a little bit. So, and Joe, and you were talking about this earlier, where maybe there's a little bit more room for interest rates to go higher than lower just because of that. And so the way that we've positioned portfolios is very short maturities where they're not very sensitive to interest rates. Now, if interest rates were to go negative across the board in the U.S. to where now all of a sudden the bonds are having to pay to own them, we would reevaluate, and we've got a few thoughts on what we would do, but I don't want to, they're still in the formation stage, but we are talking about what we would do in a scenario where all the U.S. interest rates are negative. We're protected right now as far as significant price movements, I think, but if we needed to generate income, we certainly don't want to be invested in a bunch of negative yielding instruments, and so we've got a few ideas on the table.
How risky are opportunity zones to invest in?
They could be very risky. There's a little bit of tax benefit there. So you're just looking at, these zoning. So let's say if you wanted to exchange a property and you buy into an opportunity zone where you can defer some of the tax. It's I think it's just like with anything. Some of them will do very, very well. Some of them will do very, very poorly. So it's just doing your due diligence. If you're going into an opportunity zone, what zones are you going and what are you actually purchasing in regards to the real estate that you're owning? And then seeing what some of them will absolutely do awesome, fantastic. So, but it's not, you're painting a broad brush of saying opportunity zone. You're buying real estate. So just like with any other asset or asset class, there's very differences, degrees of risk. So it's just, again, diving in a little bit deeper.
Okay, this is a two-part question. How do you think this downturn will impact the San Diego housing market? And if there are favorable real estate buying or investment opportunities due to the crisis, what are the pros and cons of doing so?
I think anytime when you want to purchase real estate, you have to have cash flow and time. And it depends on what your goals are in regards to holding real estate. Because real estate, you look at it, you look at the growth component, you look at the income component, and you look at the tax benefit. And then you add those three things up, and then that equals your total return. So for years and years, San Diego or Southern California has been a very good growth asset class in regards to real estate. It doesn't cash flow as well because the prices of real estate are very high here in respect to other parts of the country. I'm from Minnesota. So you can buy a very nice brand new build home for $200,000. That you try to buy that here in Southern California, it might cost you $1 million. So you're looking at the growth component of it. In Minnesota, you're probably not going to get a lot of growth, but you could get decent income because the rents are relative. So, you have a house worth $200,000, you could rent it out for $1,500. You have a house here that's worth $500,000 and you rent it out for $1,500. You got to look at your cash on cash returns, your cap rates, and everything else. So is there going to be buying opportunities in real estate? Sure, there's always buying opportunities, but you have to have time. And then what's your goals? Do you want to, is it an appreciation play? So like, I want to sell this thing in 10 years. If you're buying it for cash flow, then you have to take a look at different parts of the overall county. So the homes that you and I live in are probably not the appropriate homes, in my opinion, if you just run the numbers on good cash flow. But they could be phenomenal for growth. So if you're by the water or somewhere by the west of the 5, you're not going to get a lot of cash flow. But those will continue to appreciate because if you look at San Diego, right, you got Mexico, you got the mountains, you got the water. There's only so much land here. So over the long term, I think it's a great appreciation asset. But if you're looking for more cash flow, you just got to be careful of where you're buying and making sure that you run the numbers because there's always going to be good deals, but you just got to know what you're doing.
How is the coming presidential election likely to affect the market's performance?
It's funny because that was the number one story probably until coronavirus hit. I think the biggest wild card in the upcoming election was the Bernie Sanders candidacy, and with that off the table, I think markets were viewing that as the worst case scenario, and you would see as his popularity surged, markets were falling and stuff like that. I think from the way it looks right now, markets they like Trump and they've responded well under the Trump presidency, at least until recently. It seems like they can live with Biden as well, so I'm sure that we'll get some volatility as it gets closer, but right now it's effectively a non-issue and it's all Corona all the time, and that's really the only thing impacting the market.
Then what concerns you the most about the next 12 to 18 months, and what gives you optimism in the same period?
What concerns me is how quickly we can restart the economy, how long it takes people to get back to employment, and then how behavior patterns are changed because if somebody's, let's say, been underemployed or unemployed for the last few months and has run up credit card debt, maybe they spend less coming out of this. Maybe even if people are back to some sense of normal, they're not traveling to conventions or conventions aren't happening, and that tends to have trickle-down economies or effects in the economy. What gives me the most hope is just how resilient Americans are and just how resilient and dynamic the economy is that you see out of every trial we've ever come up with, companies have come out with new products, new innovations that have made life better. And so I think it's inarguable that out of this will come companies that do things and provide ways for us to entertain ourselves and live our lives that we never even thought of, and that there will be amazing economic opportunities to come out of that. It's just that the path from here to there can sometimes be bumpy.
Andy, we got time for one more.
I think the rest of the questions have pretty much been answered and should probably be taken to individual emails.
Okay. All right. So look at that. We finished right on time, 45 minutes. Hey, again, we really appreciate you guys tuning in. Hopefully you're enjoying these little chats that we're doing each Tuesday. We're reevaluating if we're going to continue to do them weekly. I think this is our 5th or 6th week. Can you believe it's already been like, that long where we've been shelter in place and, working from home and all the other, craziness that we're going through. But I think there is a little bit of light at the end of the tunnel here. Any questions or concerns, please reach out to us or your advisor. We truly appreciate the trust that you've given us. And hopefully you find these valuable. Still stay safe. These are definitely trying times, but our health is the only thing, we can get through this, but we want to make sure that everyone is healthy and happy. So, Andy, appreciate you helping us out again today. And we will be talking to you guys real soon. Have a wonderful rest of your day, folks.